example of how important they are, because when I talk to international investors, for example, they're not interested in 195 different approaches for valuation, or however many countries there are in the world now. They want to see one approach to valuation. They want to see consistent, high quality professionalism. They want to be able to compare and contrast assets in different parts of the world. They want to be able to make important decisions based on confidence as to whether to sell an asset, buy an asset, what the value is for financial reporting purpose. Obviously, these things vary. And so just as we have it in sport, it's really important for them to see one approach around the world. So I use that analogy as an example of why it is really important to have an international valuation standard. IVSC actually has two pretty simple goals, or simple to say, more complicated to achieve. We want to establish and evolve globally consistent, high-quality international valuation standards across all asset classes. And we also want to encourage quality valuation professionalism globally. And the two go hand in hand, because international valuation standards as principles-based standards are never going to cover all of the knowledge that you need in each country. So they're not going to cover what local legislation requires from an India point of view or from an Australia point of view. They're not going to cover things like the taxation issues specific to those countries. It's really important to have a professional body or professional bodies in each country that can develop the profession, can ensure that valuers have the right competencies, can provide a consistent quality approach. And so we look very much to work in cooperation and partnership with different organizations around the world. And obviously, one of those key partners for us is AARVF. And it's really important to us in terms of both getting input to help evolve the standards, getting insights from the India perspective, but also having an organization which will help develop the profession and which will help provide relevant training. And I recognize in India there are multiple organizations that do that, and look, we have an open door from an IVSC point of view. We want to participate with as many different stakeholders in the ecosystem as possible. And interestingly, when I look at IVS and I look at the participants, we look to have as many participants from around the world as possible. And if I look at our boards, we have people from, I think it's 42 countries. We have over 130 experts that are involved in our boards, working groups, outreach, that sort of thing. And that helps us function, and it also helps us have a global perspective. And we encourage as much input from around the world as possible. We don't mind where the good ideas come from. We're a facilitator. So we want to take the best ideas wherever they come from and look to incorporate those into the standards. And interestingly, when I look at the structure of IVSC and I look at the two countries, I suppose, that have the most representation in terms of staff, in terms of board and committee members, actually it's US citizens and it's India citizens that happen to have the most participation. And that's not deliberate. It's come about because people have applied for different boards and that sort of thing. But those are the two most successful countries in terms of influence, in terms of international valuation standards and our organization. So India actually has a very strong voice on the international valuation stage. For those of you that don't know, our organization is independently led. So we have a board of trustees chaired by a former finance minister from Singapore. And there are former regulators on there, there are business people. But the important thing is that most of them are non-valuers, and that's deliberate because that gives us credibility when we talk to ministers, regulators, those sorts of people. And so we find that's something that's helpful to us, and it's also helpful to you as a profession. We also look in terms of stakeholder engagement to engage with many different types of stakeholders. And so if I'm thinking about India, that includes the MCA, it would include IBBI, it would include SEBI, and we have met with many of the key stakeholders in your market, and we look to do the same around the world. For example, we have an agreement with an organization called IOSCO that brings together the SEBIs, the securities regulators of the world, and leaders from there. And there's a joint valuation working group with them. And so that is something that is important to us. On the investor front, we have brought together a grouping of investors that meet on a quarterly basis. And that includes valuation leaders from the top sovereign wealth funds in the world, the top private equity funds in the world, and some of the major pension funds. And they have more than 21 trillion US dollars in terms of investments. And so it's really important to engage with these different types of organizations that are buyers and end users of valuations, both on a national basis and an international basis. We've done similar with the biggest investment banks in the world. And when they're looking at India from an investment point of view, really important to them that there are valuers operating in the market that understand international valuation standards and can apply them in a professional, ethical way in order to give them that, give them the consistency and quality that they're looking for. And as you guys know, India in many ways is a big exporter of valuation services. There are key intellectual hubs, if you like, for some of the major professional firms in the world that have valuation expertise based in India that helps the rest of the world, whether that's on a virtual basis or in-person basis. And so there's a huge relevance to international valuation standards in terms of the business that the valuation community do, both in India and elsewhere. We have engagement with things like the UN, the World Bank, Asia Development Bank, organizations like that that are looking at enhancing capabilities across the region. And so we look to work very closely with them as well. There are organizations like the UN WIPO, which is looking at things like intellectual property. So they're looking at how can they do the same as has been done with real estate, where investors and investment banks and others have confidence in the valuations to the extent that they will provide investment or loans. But how can they do that for intangibles as well as tangible assets? How can that ecosystem be developed from a standards and a professionalism point of view? And so we're seeing more and more activity in relation to this. And the links from my point of view between the Indian profession and the need for international have never been more important. And it's great to see so many participants from India playing a key role on the international stage. One of the things I'd like to highlight, just in terms of concluding remarks, if you like, is we're delighted that for the first time ever we will be having our AGM, our annual general meeting, along with a conference here towards the end of October this year. That's the first time we have been able to hold this in India, and we're particularly pleased to be able to do that, and thankful to AARVF as well as RICS for being key hosts in that regard. And so I hope that we'll be able to see many of you in person at that event, and that you will enjoy being the center point, the focal point, if you like, for global valuation leaders that will be coming to India from around the world. With that, I know this is supposed to be a technical session, so I will hand back over to Sandeep and Kim, who I'm sure will give you some very insightful training in relation to international valuation standards. Thank you for your time.
Thank you very much, Nick, for your wonderful speech and what you have shown regarding the international valuation standard and their confidence over the India as well as Indian valuers. We are really hopeful that in future we will work together for the progress of the valuation profession as well as the valuation professionals. So what you said is correct, that we are here for technical training program. So without wasting any much time here, I would like to request my chairman there in the tangible asset board, and he said that no cricket, no cricket. When we discuss valuation, no cricket. So I will following that, no cricket further. Although his temperament I know is very well now because the position of no cricket. I'm sorry. So Kim, it's over to you, and the entire all are waiting to listen from you. Kim Hindenburg.
Thank you, Sandeep. I'm not sure about your positioning on the cricket, but let's just see how we go over the next couple of minutes. Thank you for those kind words, Nick. It's very kind of an Englishman to praise Australia and put Australia up on the pedestal in terms of the cricket. And Rahul, thank you for your kind words as well. Well, I think as many would have crossed paths with many of you at the V20 summit in Delhi going back some time ago, and if I remember, Nick was a little bit off when he referred to the current standings within the cricket, because I believe that Australia is currently the 50-over champions as well. So admittedly, India has taken the title in terms of the international T20, but I just had to quickly look it up just to make sure that I was correct. And yet that is correct. When I was in India last time, we did beat India on home soil in the 50-over World Cup. So we're currently the 50-over champions. But I did have the pleasure of actually attending the Boxing Day Test match at the MCG going back last week. Nick touched upon some of the many things, that we, some of the similarities, I suppose, that we share with sport. But it's events like this, and in sharing in the common vision for valuation standards, that we come together in similar ways that we do with sport to try and drive the profession forward. So at the moment, it is summer here in Australia. That means festive season. Clearly, we've got New Year there. For some, that means spending time by the beach. It's very hot here in Australia at the moment, hence no tie for me tonight. It means tennis because we host the Australian Open as well. But absolutely it means cricket, and I've been out playing cricket tonight already with my son, but very much with Australia versus India on at the moment in the Test cricket. It's a very common topic. So I won't talk too much more about cricket, Sandeep. I think we do have to talk about a little bit of valuation topics tonight, but thank you everyone for that kind introduction. That is fantastic. Rahul, are you able to share the presentation?
Yes, I'll share it.
That would be great. I think we've got around about 30 minutes for my slot in terms of this. By all means, I'll be available subsequent to delivering a handful of slides on this particular topic as well. And we can have a Q&A at the end also. But I just wanted to echo Nick's words in that this looks like a fantastic webinar series that we've got going here, put on by the IVF. And so thank you very much for inviting us here to present. And I know there will be a number of other speakers that will be coming over the coming weeks, but it looks like a really exciting series to talk through the new edition of the IVS, which will come into play officially for those that haven't already adopted it by 31 January this year. So is that currently sharing, Rahul? I can't hear you, Rahul, sorry.
Yes, Rahul is sharing. I can see the slide.
Fantastic. Okay, that's great. That's not coming up on my screen, but that's great. I'll tell you when to change slides, Rahul. Okay, thank you. So just on to slide 2. I think there were a handful of key considerations, given that our topic today was specifically focused on IVS 100 valuation framework. When when I was going through over the last 24 hours just to think about some pertinent topics that I would like to talk about, there were 6 things that come to my mind in terms of the pertinent topics within IVS 100 valuation framework that I would like to share. I think the first one that I'll go through, and I'll have a slide for each of these topics, but is the alignment of IVS with the valuation process and the introduction of chevrons into the valuation process. I think that's probably the first observation that I'd like to make. We've got the introduction of this this concept called professional skepticism. So we'll touch upon that. One thing that will be very clear and obvious for a number of people is the introduction of valuation process quality controls. So we'll touch upon that one briefly as well. We've got the concept or the use of a specialist or service organisation. And so there is some official content within the IVS now, within the IVS 100 valuation framework section. There's a section now on compliance, and there's also another piece just in and around effective date of IVS. And so I'd like to touch upon that if we could, as well as we're going through. We've got around about 10 slides. So we'll touch upon each of those topics that I thought were either key additions or slight changes to IVS this time around. Next slide, please, Rahul, to slide 3.
Okay.
Thank you. So I think the first one that you will see in the image and the diagram that we have here is the alignment of IVS with the valuation process. So you will now see up the top of each of the different sections within IVS. So this isn't specifically around IVS 100 as such, but it is incorporating all of the different sections within IVS. That you'll be able to see that the IVS is now aligned with a typical valuation process. So starting about when we start thinking about evaluation, to performing a scope of work, thinking about basis of values, valuation approaches, data and inputs, valuation models, documentation and reporting, and then the subsequent asset standards. So in the new edition of IVS, you will see that it follows this particular valuation process. So we internally at the IVS call these chevrons. Some of you might call this a valuation process, but you will notice that is an obvious change collectively within IVS. But you will see that at the very first part is IVS 100. So it forms a very, very start of IVS and hence playing a really important role in setting the framework. IVS 100 forms part of the general standards, and it's a requirement that is applicable to all classes of assets and liabilities. And then asset standards follow subsequent to the general standards, and they provide additional requirements for specific assets and liabilities. And I'll show a diagram in subsequent slides shortly that narrates that as well. There's also the introduction of appendices that provide additional information and requirements for certain concepts that articulate various different components of the different chapters as well. Next slide, please. And so again, this diagram illustrates the structure, the current structure of the IVS. And so you can see that we have general standards that are encompassing up the top. Sitting underneath that, we have the asset standards, which in the light blue there comprise business and business interests, IVS 210, intangible assets, IVS 220, non-financial liabilities, and IVS 230, inventory. We have the tangible asset standards, which is the board that Sandeep and myself sit on, being IVS 300, plant, equipment and infrastructure, IVS 400, real property interests, IVS 410, development property, and then we have the financial instruments chapter as well, being IVS 500. So IVS 100 valuation framework sits up there in that red box in the general standards. That's what we're going to be talking about today. But thinking about any valuation that you are conducting, the red box, as you can see, is overarching it pertains to everything, every valuation of all different assets. And then depending upon the asset class that you're looking at, you'll then delve down into your asset standards that sit below that. Next slide, please. Starting with section 10, I think the first thing you will note with section 10 is the introduction of this concept called professional skepticism. And it says in 10.04 that the valuer must apply an appropriate level of professional skepticism at every stage of the valuation. So this is an additional paragraph, if you like, that's been introduced into IVS 100, which is in addition to the valuer principles of ethics, competency, and compliance. And so professional skepticism has been defined as an attitude that includes a questioning mind and critical assessment of valuation evidence. So thinking about the key change within section 10 there of IVS 100 is this introduction of this concept called professional skepticism. Next slide, please. The next section that we touched upon just before was the introduction of valuation process quality control, which is contained within section 20 of IVS 100. I think if we think about valuation process quality control, this is probably an area of significant interest all around the world for all different asset classes because of the overarching concepts that it tries to apply to valuation. So the concept of valuation process quality control, it doesn't matter if you're a sole practitioner, if you're a mid-sized local firm, or if you're a global multinational firm, valuation process quality control will pertain to all different types of valuations. And so the question there becomes, how do you become comfortable with valuation quality control within your organization? It is a core component of valuation, and it seeks to ensure that there is objective, transparent valuations that adhere to IVS with the aim of mitigating valuation risk. I think that's the overarching aim of the introduction of this section. There must be valuation quality controls no matter what type of valuation that you're doing, no matter what type of asset class or the jurisdiction that you're doing that within. And, again, the overarching concept is that a valuer should conclude that the level of valuation risk is appropriate given the intended use of the valuation, the intended user of the valuation, the characteristics of the asset or liability being valued, and the complexity of the valuation that is being valued. And so, I don't, and as Nick touched upon before, we are a principle-based standard setter. Valuation process quality control may have, different impacts depending upon the jurisdiction or the asset class or the type of valuation that you're doing within your jurisdiction. Valuations have all different levels of risk. And so if you're going to a court and you're acting as an expert witness, there's probably a very, very high level of risk for a valuation assignment of that nature. In some jurisdictions, financial reporting have a very high level of risk. In other jurisdictions, financial reporting are perhaps a little bit lower on the risk spectrum. Insurance valuations in some jurisdictions may not be as high a risk as what they are in other jurisdictions as well. So depending upon your asset class, depending upon your jurisdiction, the regulations that you need to follow within that jurisdiction, your valuation process quality control may have to be thought about in different ways. But the introduction of these principle-based set of standards around quality control is seeking for valuers and valuation firms to put in place processes that help try and control quality as part of valuation process, but then also to think about mitigating that risk in and around the valuation process. So I would encourage you, if you haven't had a look at section 20 of IVS 100, subsequent to this particular training session to go away and have a good read of Section 20 around valuation process and quality control. Next slide, please. The next section that I wanted to touch upon was around the use of a specialist or service organisation. Many valuations, regardless of the asset class that you value, will occasionally need to use third-party specialists or third-party service organisations when performing a valuation. And so, for example, a couple of examples that I can think about is that you may be involved in valuing an asset that has a significant amount of environmental contamination. And so whilst you aren't an environmental expert as such, and you can't necessarily quantify the extent of the environmental contamination, you may be required to work hand in hand with an environmental company to assess the environmental damage that might have been done as part of your valuation assignment. For other assignments, you may be required to do a detailed cost estimate in terms of what would the asset cost you to replace. So for some assets, that is very much within the remit of a valuer. If it's a vanilla type of asset, for other highly specialized types of assets, the valuer might feel uncomfortable in estimating a replacement cost and might require a quantity surveyor to assist them in that particular process. And so the introduction of this section around the use of specialist or service organisations attempts to foresee that valuers do need to use these organisations sometimes to perform their valuation, but it seeks to put in place a couple of different things within 30.02 and 30.03 of IVS 100. And that is that, prior to using a specialist or service organisation, the valuer must assess and document the knowledge, skill, and ability of the specialist or service organisation. Okay, so, effectively do an assessment on that specialist or service organisation before using them. And things that they might think about in terms of the factors might include, but aren't limited to, the experience of the type of work that they've performed, the professional certification licenses or professional accreditation that they might hold in their relevant field, or their reputation and standing that they have as a specialist or service organisation. And then within 30.03, it tries to encourage a valuer to, they must obtain an understanding of the process and findings to establish a reasonable basis to rely on the work of that specialist or service organisation based on their professional judgment. So, whilst it might be good to engage a third-party organisation in terms of a specialist or organisation to perform a certain piece of work for you within a valuation process, the valuer shouldn't just blindly rely on that information. They should know also how to use it. And so the introduction of this section within IVS 100 attempts to not only allow valuers to bring other organisations to the table to help them do valuation assignments, but also ask them or challenge them to think about the credibility of that organisation and exactly how they're going to use that content as part of their valuation assignment. A really important introduction to IVS this time around. Next slide, please, Rahul. We have compliance section within section 40. And I think, it starts off importantly as part of 40.01. And it says that in order to be IVS compliant, the valuation must meet the requirements of the general standards, the appendices, as well as the asset standards, if applicable. And so you will see here that there is this this concept here that we have within 40.02 that is explained as being requirements that are mandatory and must be met as part of an IVS compliant valuation. Within 40.03, we have principles and concepts that might mandate any specific action to provide fundamental principles and concepts that should be considered in undertaking evaluation. So this concept of mandatory requirements that must be followed, but then also concepts that should be considered in undertaking evaluation. Really important paragraphs there at 40.02 and 40.03. Another really important paragraph here is that in 40.04 and 40.05 is that whilst the IVS does seek to provide that playing field for everyone around the world to be able to perform evaluation, without doubt there are always going to be exceptions within certain jurisdictions or within certain regulatory frameworks where IVS might slightly deviate to what is required in that jurisdiction or within that particular regulatory or statutory environment. And so what 40.04 and 40.05 seeks to do is it seeks to allow valuers to deviate from IVS around certain aspects if you'll read within 40.04 if there are legal, statutory, regulatory and or other authoritative requirements that are appropriate for the purpose and the jurisdiction of the valuation that conflict within IVS. So a really, really important paragraph there at 40.04. And then within 40.05, it effectively says to valuers, hey, if you do have a particular aspect that has come up within your valuation that doesn't meet the requirements of IVS, but it does meet the authoritative requirements of the jurisdiction that I'm performing evaluation in, then the valuer should disclose it within their valuation assignment. And as long as they do that, it can still be considered an IVS compliant valuation because the legal, statutory, regulatory, or other authoritative requirements have taken precedent within that local jurisdiction. And so two really important paragraphs there at 40.04 and 40.05. If we go down into 40.06, we talk about the fact that if there's any other deviations that aren't necessarily subject to paragraphs 40.04 and 40.05, then the valuation will not be compliant with IVS. So we now have this introduction of this IVS compliant valuation within the most recent edition of IVS. And, again, that sort of, again, seeks to follow the chevrons that have been introduced that we talked about before, or that valuation process. If you go through that valuation process and you get to the end of the valuation and you followed all of the things within IVS, then you will be badged either as having an IVS compliant valuation or potentially a non-compliant valuation, depending upon how you've gone there in 40.04, 40.05 and 40.06. Within 40.07, it then just seeks to add, there may be some asset classes there that you are valuing an asset, but you're not too sure exactly what asset standard that asset falls within. So, for example, some people might consider a certain asset being infrastructure and associated with IVS 300. Another person might consider that asset being associated with real estate and following IVS 400. Regardless of what you follow, being 300 or 400, 40.07 just seeks for the valuer to provide clarity around the asset standard that they might have used, where there is perhaps some confusion around the asset standard that should be appropriate for that particular type of valuation. Next slide, please, Rahul. The next thing that I wanted to talk about was within 50.01. And to many of you that conduct valuations that are commensurate with the day that you do the inspection, this might not necessarily be an issue at all. But 50.01 seeks for 50.01 specifically talks about when the IVS becomes effective, or this edition of the IVS becomes effective. So as we've already alluded to as part of this training session, it becomes effective on 31 January of 2025. It was published on 31 of January 2024, but with an effective date of 31 January 2025. There may be some organisations around the world that have already adopted the most recent edition of IVS, and early adoption is permitted. Within 50.02, it is particularly relevant to people that might be conducting valuations with a retrospective or a historical valuation date. So if you're conducting a valuation today of a particular asset, 50.02 won't necessarily apply to you because you'll just say, hey, I used IVS 2025 or I used IVS 2022. The thing that I've prompted there on the slide is, what if you have a valuation date of the 3rd of January 1985? So what if your valuation is retrospective by 40 years? What edition of the IVS are you going to use? And so what 50.02 seeks to do for the valuation professional is that it says very clearly, when undertaking valuations or valuation reviews with a retrospective or historical date, the valuer should document the additions of IVS A that they have relied upon in doing the valuation and that are applicable as at the valuation date. And so if you are doing a valuation at the 3rd of January 1985, my preference is for those people that are doing retrospective valuations that they should always use the most recent edition of IVS. But there are some people that do believe that they should use the edition of IVS that was relevant at the valuation date. Regardless of what way you go in performing a retrospective valuation, 50.02 makes sure that the valuer provides transparency that's associated with their valuation when they're conducting that. And so for the users of that valuation, it is very clear the version or the edition of IVS that they have relied upon, regardless of the valuation date that is used as part of that valuation assignment. So for those that are conducting retrospective valuations or non-current valuations, this is a particularly important section that seeks for further transparency as part of the valuation process. Next slide, please, Rahul. So, look, I think, going through each of those 6 different key and main changes to IVS 100, I think hopefully that gives you a good overview for where some of the changes or additions have taken place within the current edition of IVS. What I would encourage you to do, though, is and what is a great feature that is now coming out of the IVSC is that IVS is now going to be published and freely available for all stakeholders to use. That's fantastic to get a clean edition of the IVS so that you can, 1, use it yourself, but then 2, give a copy to your clients to educate them as part of the valuation process or other valuation stakeholders. But what I would also encourage you to do is to obtain a copy of the red line edition of IVS 2025 to see where the key changes have taken place. And so the clean version clearly doesn't show you where those current changes have taken place, but if you get a copy of that red line edition, you'll be able to see exactly where the key changes have taken place, not only within IVS 100, but within all of the other general standard sections and all of the asset standards as well. So when you go away after today's call, seek to obtain a copy of that red line edition of the IVS to see where those changes have taken place. And 31 January 2025 is almost upon us. And so for those that haven't already implemented the most recent edition of IVS and aren't an early adopter, I think, there are some questions there for you now over the next month or a little bit less than a month, 4 weeks, as a matter of fact, to think about, well, for me to perform an IVS compliant valuation on the 31st of January 2025, what do I need to do between now and then in order to make sure that my organisation is going to be producing IVS compliant valuations? So that red line addition will be a really useful tool for your organisation to think about when you're thinking about your valuation quality control. That red line will be a really useful tool for you to assess the things that have changed since IVS 2022 to 2025 when you're seeking to implement the new standards. Sandeep and Rahul, that's all I've got in terms of the formalities of what I wanted to present in terms of the overview of the main changes and additions of IVS 100. I am open to questions from the floor or any other medium that you'd like to follow as part of this particular training session. So back over to you, perhaps, Sandeep.
Yeah, thank you very much, Kim, for touching upon, time is very short and it's a huge subject, and you have touched upon the points which are very relevant to the valuers who are working in India and abroad. So now the session is open to the participants. If anybody wants to ask any question, any doubt on Kim's presentation, please ask the questions. Tell your name and ask the question.
I have one question.
Yeah, hi. Yeah.
Myself, sir, Moina Ghosal. Actually, sir, I am wanting this video. Can I get this? Can you share this video?
It could be done. Thank you very much. Any
Thank you,
other
sir.
question, please?
Yeah, so I have a question for Kim. Yes. So,
Sir, I have one
IVS 40. May I complete, sir? May I ask my
Yes,
question?
please.
Mr. Saha, yes.
Thank you. Thank you. Kim, so IVS 40 now has allowed usage of external specialist professionals for certain things. Now, if I look at the Indian regulatory regulations, which is the company's registration of valuer rules, there is a requirement there which says that the registered valuer is allowed to make use of external specialists. However, the liability of the valuation still lies with the valuer through and through, right? So is there anything similar to that? What's the IVS or IVS's take, either as a guidance or as if a valuer is using an external expert, then the professional liability issue. The reason I'm asking this is because then it needs to tie up with the terms of engagement and the contracting terms on which IVS also gives certain guidance. So accordingly, if you can throw some light on it.
Yeah, no, for sure. Look, a really good question. IVS doesn't, because of the many jurisdictions that we cover, we clearly don't go into liability and where that may lie. I think probably the best section that I could direct you to in terms of IVS 100 would be within section 30.03. And so within 30.02, as we went through before, that does seek for the valuer to assess the particular specialist or service organisation. Okay, so don't just use that service organisation blindly, but within 30.03, it puts a little bit of responsibility back onto the valuer in that if a service organisation or a specialist provides you with an input into your valuation, should I just use that input blindly, or should I should come to the table having, some good awareness of, as 30.03 states, they must attain an understanding of the process and the findings to establish a reasonable basis to rely on their work based on their professional judgment. And so that doesn't go into the specifics of where liability might lie. Again, thinking about Section 40, when it talks about legal, statutory, regulatory, or other authoritative requirements, depending upon the jurisdiction that you are based within, that might change that responsibility in terms of using specialist or service organisations. But it does try and set a principle-based framework for valuers to think, assess the specialist or service organisation that they're using, make sure that they're credible, make sure that they're experienced or they're certified, and they have reputation and standing. But then within 30.03, do try and think about having an understanding of how you're going to implement that as well. So, by all means, we might have specific requirements within India that might differ to other countries, but that's probably the best that I could point you to at this point.
Yeah,
really good question.
Thank you.
Adding to Kim's Barchan, actually, IBBI has a very good thought, and they have introduced this involvement of the specialist before IVSC thinks about it. So actually, the new section, the new paragraph introduced in the IVS 100 has strengthened the thought process of IBBI, and actually it's almost the same. Now IVS has also recognized the involvement of specialist or specialized organizations with the work of a valuer. And what Kim has said is perfectly right, that it is valuer has to have that judgment that which professional he is appointing, because this is called a professional appointment. The valuer has to give an appointment to that specialist. So the valuer has to choose. The choice of the specialist is up to the valuer. So it is up, the responsibility definitely comes to the valuer, whether he is choosing the right persons to give him the input or not. So thank you, Kim. So any other one? Next question, please.
Thanks, Sandeep. We do have a question there in the chat, and I think it's Deval has asked a question. I did try and touch upon it within the final slide, or the second last slide, but the question is, can we follow IVSC 2025 for the valuation date of the 1st of April 2001? And so we have a retrospective valuation date. What version of IVS do I use? So my answer to that question, if I was doing the valuation, is that I would use IVSC 2025. But clearly, when you're using the most recent edition of IVS 2025, you still need to consider the market conditions and the transaction evidence that was relevant as at your valuation date. Now, I'm not too sure if the IVS was published, I believe, in 2001, and it is some time ago. I think regardless of the edition that you do use of IVS, what it does ask you to do is it asks you to be transparent in your valuation report. So if you have a valuation date, which is the 1st of April 2001, and you use IVSC 2025 to perform your valuation, you should put that within your valuation report, so that the users and readers of that report are very, very clear on exactly how you've gone about that valuation process. You might also seek clarification in your instruction if you're unsure. So if you are doing this for a legal purpose, for example, you might seek clarity from your instructor in performing the valuation, the addition of IVS that you should use in performing that valuation. I think that could be another way that you take the guesswork out of it from your own perspective and seek input from your instructor. I think that would be good guidance as well. The next question we have there is, why is the IVSC 2025 is not printable? By putting restrictions to print, there is discouragement. It's a good bit of feedback. Perhaps that's one I could take back to Alex there at the IVSC. I know I did have challenges as well doing copy and paste from the PDF. So I think we'll take that back on board as an administrative matter back to the IVSC, and we can touch on that in that way. Are there any other questions there, Sandeep?
Is there any question? If anybody wants to ask any question to Nick, to Kim now.
Kim, good evening. Good evening, Kim.
Good evening. Hi, how are you?
I'm Sundra Pandian. I am from Chennai, India. See, in India, we do land and building value, we do valuation of asset. But as such, we are not doing value of liability. If you see one of the slides, you mentioned actually the value of liability has to be done. But what is that actually if we are not doing? Maybe it is you also, you can also comment.
Yeah, look, I'll take a start on that one first. I think the first most important point is to consider the instruction, your valuation instruction. So in some instructions, you may be required to value an asset without considering liabilities that might be associated with it, and that might be someone else's responsibility. But that would depend upon your jurisdiction, I would say. So within my jurisdiction, you could be required to do both. So you could be required to consider the liability that's associated with an asset. In others, in my jurisdiction, you may not as well, depending upon the type of instruction that you receive. I think in any case, if you're performing a valuation, my advice would be that, again, you should try and be transparent. If you think that there could be a liability, or if you haven't considered any potential liabilities that are associated with that asset, you should be clear about that in your valuation report as well. So I'd seek clarity in your instruction in the first instance, but maybe Sandeep might be able to provide some local context on that particular aspect.
Okay, in that case, actually, we can record that my scope is only to do the valuation of asset. A liability we are not done or something like that, we can write. Am I correct?
Sandeep.
Yeah, actually, what happened, we value the rights and interest embedded in the property, whether it is an asset or a liability. Right. So if I have been asked to do the valuation of the interest of an asset, we'll do the valuation of the interest of the asset. If we have been asked to do the valuation of an interest of a liability, then we have to do the valuation or valuation of the interest of the liability. So it is absolutely on the client what he is looking for. If the work order says, the scope of work says that we have to do the valuation of the asset, then we have to do the valuation of the asset. So the work order and the scope of work has to be clearly stated that what a valuer has to be done. That the valuer also communicate to the client, so that there shall be what Kim has also said, that transparency should be there, and the transparency should be there at the time of providing the scope of work in the work order. That is the way the valuation should be done.
Okay, thank you, Kim.
Thank you. We've had a comment from Alexander Aronson in the comments there that the IVS is now freely available online, and he is going to check regarding the printability of the online version. So Alex will come back on that and hopefully remedy that issue if there is an issue with that. Thank you, Alex. We have another question there in the chat, how to evaluate risk premiums. I'm not too sure that I could answer that one on this particular call. That's probably going to depend upon your particular jurisdiction and asset class that you're looking at within your market. I'm not sure I have a quick answer for that particular question, I'm afraid. Any other questions from any other participants? I'm surprised we don't have a lot of questions for IVS quality control, Sandeep. We have a question there whether startup valuation methods are prescribed as valid methods as per IVS. If yes, please provide specific para of. I don't think that I can specifically target a particular paragraph within IVS for startups, I believe. So I'm not too sure if I have an answer for that one either, Sandeep.
So I would like to request everybody restrict your questions within today's topic, which is IVS 100. If you have and the IVS 100 as well as the introduction part of the IVS. So definitely we'll come to the next ones when we'll come to the in other programs, right? So today we will try to confine our questions and answers within this IVS 100. That will help all us. Thank you.
Okay. We have another question from Deval there. What are the disclosures required for valuation risk? Really good question, given there are so many elements of valuation risk that have now been added within IVS. Deval, I think there is an increasing amount of transparency that is requested by IVS within valuation reports. And so to the extent that you think that there is an element of valuation risk that you have or perhaps have not covered off on as part of your valuation assignment, we're trying to mitigate valuation risk in performing an assignment as a general rule. So my advice on that particular question would be around transparent disclosure around elements of valuation risk that you think you might have covered off on other elements of valuation risk or limitations that are associated with the valuation report that you think that you might not have covered off on. So a really good question. Transparency, I think, is the key for me. Also thinking back in terms of when you're scoping out your valuation assignment, so your scope of work with your client, if you can think of elements of valuation risk before you begin the assignment, I think that is a really good point to start talking about valuation risk with your client at the start of an assignment. If you're partway through an assignment and you uncover an element of valuation risk during your assignment, go back and seek clarification from your client or re-instruction around an element of valuation risk and how that should be treated. Regardless of what way you go, if you think that you have dealt with valuation risk or that you haven't, if you include the right limitations and transparency that's associated with your report for all stakeholders, I would say that's probably in your best interest. But try and seek clarity wherever you can. Do you have any additions for that, Sandeep?
No, it's all right. Absolutely okay.
Okay. Next question, from a banker's point of view, how does fraud or unethical practices done by a valuer get covered within IVS? There are valuer principles within IVS. So, we are always talking about the ethical nature of valuation and how they're going to be covered. Quite often, VPOs around the world will have their own ethical requirements in and around valuation process. So whilst IVS might talk overarchingly within the start of IVS around principles around ethics, there will be more than likely within your own jurisdiction from your VPO, there will be guidance around ethics, and or there might be certain ethical considerations that you would need to follow from a regulatory perspective, depending upon the type of valuation that you are doing. So again, very principle-based standards or guidance around those particular topics because of the way that certain VPOs around the world or other authoritative bodies try to implement those sorts of things around the world.
So
what is?
thank you.
Yes, Sandeep.
Yeah, thank you, Kim. So if there be any more questions, that will take up, we will take up this thing in the end of this program. So I would like to present some more slides because you have covered up almost the VS 100. I would like to take up then the glossary part, because glossary will take an important role in future, because when if you a valuer is always considered as an expert, and sometimes valuer has to appear before the arbitration tribunal or before the court of law, and even now in insolvency and bankruptcy code, the valuer has to explain this valuation report before the CIC, that is the committee of creditors. So in that case, the definitions plays a big role, and so I would like to take up that glossary part in this program. So let me share the presentation.
ఇందులో ఉన్నా కూడా నీ చేతులు లెక్క పెట్టించేది చూసా 29 ఎక్స్ట్రా ఉన్నాయి.
So is it visible to you everybody?
Yes, sir.
Presentation is visible?
Yes, sir.
Yes, sir. Perfect.
Yes, sir. Yes, sir.
So let's come to the glossary part, because in the new IVS, which has already been introduced in the 31st of January 2024, and this time the International Valuation Standard Council has given absolutely 1 year time for assessment, for going through the details, so that everybody should prepare themselves before 31st January 2025, when it will be activated. So here glossary has been provided at the beginning of the International Valuation Standard, and before they start the general standard with IVS 100, the glossary has been given. What is there in the beginning of the glossary? It is stated, this glossary forms an integral part of the standards and defines certain terms in IVS. All glossary definitions are italicized. Now, one thing is there, very important, two part, that the glossary is an integral part of the standards. So that means that if you are telling that your valuation report is in compliant with International Valuation Standard, then what is defined in the glossary, that has to be in compliance with your valuation report. And the second part, that the definitions which are given in the glossary of different terms, that is applicable for IVS, International Valuation Standard. So for explaining the terms which are there in the IVS, glossary is applicable. If you are using that terms, this definition in for some other purposes not related with the International Valuation Standard, the authority may not accept that. It is up to that authority or the the persons who are there either in the court of law or in an arbitration or whatever it is. If IVS is not a part of that, then the definitions may not be applied there. So it is clear from the beginning that the glossary defines certain terms in IVS. The first one, it says what is asset or assets. What happened in these International Valuation Standard, all the terminologies, they have been put in a very short form, not in previous one. If I am observing the International Valuation Standard from 2001 onwards, that time the definitions used to come with 4-5 lines, but now this time it is almost as short as possible. So what is an asset? It says the right to an economic benefit is an asset. We all are dealing with the automated valuation model, that is also defined here. It said that a type of model that provides an automated calculation for a specified asset at a specified date using an algorithm or other calculation techniques without the valuer. The main point here is without the valuer. applying professional judgment over the model, including assessing the selecting inputs or reviewing outputs. So, from the definition, it is clear that an automated valuation model is not a valuation, because it is using some algorithm but without the valuer applying professional judgment. So therefore, if any reports comes out through an automated valuation model, may not be accepted as a valuation report unless a valuer applies his professional judgment. The basis of value we are going to discuss in the very one specific standard has been there on the basis of value. So here it is only definition, the fundamental premises on which the reported values are or to be utilized. Then who is a client? Here it says the client is a person who engages the valuer. It might be an internal client or it might be an external client. Then what is a cost? Because we are grown up by going through the three words in valuation, which is cost, price, and value. And now here the cost is defined as the consideration and expenditure required to acquire or create an asset. So it is very much essential for all valuers to understand cost, price, and value, which is defined here as a cost. Then what is called a data? It's a quantitative and qualitative information available to the valuer is a data. Because we always say that availability of data in Indian perspective, availability of data is very rare. Is it so? Because we always criticize in India the international valuation standard that it always asks for evidence, and evidence depends on data. When data is not available, then how can we provide an evidence? And if evidence is not available, then how can we be compliant to international valuation standard? There we have to understand that data is everywhere. We must not confine our thought process that a data in case of real estate is only a registered deed. Data in case of real estate, evidence in case of real estate can be a newspaper cutting, can be an asking price in website, property website. Even it can be a hearsay. Even it can be a data available from a broker. So all these are data, and you know that there is a hierarchy of data table which will come afterwards. So data is available, evidence is available everywhere in the world. Valuers are to know how to use those evidence to create an IVS compliant valuation report. Discount rates, I'm not going to define or discuss on these discount rates because you know it very well. But when you create a valuation report, when you use a discount rate, then you have to create one chapter in your valuation report where you will define what is discount rate as per IVS. This 10.8 is a very important definition, which is this first time provided in the glossary. Environmental, social, and governance, ESG. Now, ESG definition will give you a very interesting thing here. The ESG, what is defined? The criteria that together establish the framework for assessing the impact of the sustainability and ethical practices, financial performance or operations of a company asset. So
ఇందాక మీ
here,
ఆరకాయలు తీసేసుకున్నారు కదా, ఇక్కడ పెట్టుకున్నావు కదా, అందులో మీరు పక్కకు పెట్టావు కదా ఆరకాయలు. సరే,
Mr. Surya Prakash sir, would you please mute yourself? Operations of a company asset of liability. So one point you should note here that then ESG is applicable to company asset or liability. That's a very important one that you have to find out from the definition of the ESG. ESG is applicable towards a company asset or liability. And ESG comprises three pillars: environmental, social, and governance, all of which may collectively impact performance, the wider markets, and society. So, in future days in valuation, these three pillars, environmental, social, and governments, and calculation of the valuation of the data on these three becomes very, very important. Equitable value, there is no as such big change in equitable value. Now, what is an input? A data, assumptions, adjustment determined to be relevant and assessed or selected by valuer to be used in valuation based upon professional judgment. So whatever a valuer will use in its valuation report, creation of a valuation report will be treated as an input, and that inputs will always require the professional judgment of the valuer. So this is very important thing that we have to derive from the definition, that professional judgment. When we are thinking about, now the question has come that if we can we use an input which is given by a specialist. We are using an input given by a specialist in our valuation report, and in future it is found that the input is not correct, then how the valuer would be responsible? Well, it says that whenever any data or assumptions or adjustment will be used in valuation report as an input, that will be based on, it says, professional judgment of the valuer. So whether the input has been provided by a specialist and the valuer has accepted it blindly, responsibility will there remain with the valuer. So be careful in understanding the inputs and then using the inputs in every report. Intangible assets, we know if you understand tangible assets, then this is intangible. And identifiable non-monetary asset with no physical substance is an intangible. So when we started our valuation education long back, more than 25 years, the first thing we have been told that every asset is actually what we value. We value actually the intangibles. Because at the definition of the tangible asset, it is said it is the rights and interest embedded in the asset or liability. Can we touch the interest of an asset or liability? No. So that is also an intangible. But here we say what is a tangible asset means the real estate, the plant and machinery, the equipment, the infrastructure which we can touch, and which we cannot touch is an intangible asset. There's a big change in this value in this IVS, which is the intended use. Now, up till IVS 2025, up till 2024, in every valuation, in every international valuation standard, we use the term purpose. And we frequently say that the value varies from purpose to purpose. Now, with the introduction of an acceptance of these IVSC 2025 edition, the word purpose is no longer to be used in a valuation report. The intended use is replacing the word purpose. After 31st January 2025, in all your valuation report, you got to use intended use in place of purpose. That means we have to write that intended use of this valuation, not purpose of this valuation report. It is the intended use of the valuation report, intended use for secured lending. What is intended use? Intended use is secured lending. Intended use is tax reporting. Intended use is financial reporting, not the purpose. So to make it clear that it is replacing the purpose, we have provided the last line here as this is also known as intended purpose. But from now on, for all IVS compliant report, valuers are to use the words intended use in place of purpose. Intended users is not a new term, it is an old term. Any party identified by the client and the valuer in the work as users of the valuation is an intended user. So intended users is an identified party by the client and the valuer. So your client may be an intended users, or your client may instruct you to prepare the valuation report for any other person, third person who might be the intended user. So in your scope of work, which we will discuss in the next week, the intended users may be your client, may not be your client, and the intended users may be more than one persons. That also you have to understand. Investment value, there is nothing to discuss further because investment value will be discussed later on in a detailed way. Jurisdiction is a term which is very important. Again, why it is important? Because of the applicability of IVS, and what in IVS 100 theme has already discussed it elaborately, that a valuation report will also become compliant with the international valuation standard if the deviation takes place. If there is a deviation from the guidance of the international valuation standard, but the deviation is according to the legal and regulatory environment, what the legal statute, legal or authoritative requirement of that jurisdiction, then the valuation report will be in compliance with the international valuation standard. So jurisdiction is a very important terminology, which is the legal and regulatory environment in which a valuation is performed. A small example, you all are working in India for valuation for capital gain tax. Now in the capital gain tax, and another very common example of jurisdictional difference between IVS and the statute is that in case of tax calculation in a municipal area, the many of the municipalities, they use the annual value technique. And annual value method is based on the income approach. Whatever be the income from the property, that will be capitalized to get the, that will create the annual value of the property, and from there the tax is determined. But in most of the cases, the valuation of a flat or a building is generally done by the market approach. But when you are doing this is for the purpose of municipal taxation, the jurisdiction, it says that it has to follow income approach. So that way, it is not following IVS. Even then, it is in compliance with IVS. So there lies the supremacy of the jurisdiction. Whatever jurisdiction and what the jurisdiction says, the legal or regulatory framework, a valuer has to perform accordingly. Now one question came, why we will do asset? We are doing here in India only valuation of asset, no liability. What it says, what is the liability? The present obligation to transfer an economic benefit. A liability has the following two essential characteristics. It is a present obligation, and the obligation requires an entity to transfer or otherwise provide economic benefit to other, right? So what Mr. Sundar Pandian was asking, that here we are the valuers are used to do the valuation of the asset only, because the client want to do the valuation of the asset. Client don't want to get the value of the liabilities. But sometimes it happens in case of valuation when we do for court or for the purpose of arbitration, sometimes the valuers are to ascertain both the value of the asset as well as liability. And that means when we do the valuation of assets or valuation of liability, it is required for us to define the asset as well as liability as per as the glossary of the IVS when the report is being prepared in compliance with international valuation standard. So there we have to give the definition of the liability. There we have to give the definition of the asset also from glossary, so that our client or the other intended user can understand the difference and what is our final conclusion. Liquidation value. There is a big change. There is a big change in liquidation value definition. And this change because the liquidation value is widely used in India, you know very well, after the introduction of the Insolvency and Bankruptcy Code. In Insolvency and Bankruptcy Code, valuation played a big role, and there a valuer has to estimate both fair value as well as liquidation value. Well, the fair value definition, what is given in bankruptcy code regulation, is not matching with any other definition of fair value anywhere. Liquidation value also, because it is stated in the valuer's rule that valuer has to do the valuation as per the internationally accepted valuation principles, and liquidation value definition is given in international valuation standards 2024 as well as previous editions also. So the valuer used to take that definition from the international valuation standard and used to do the valuation of the assets on piecemeal basis, because in the previous edition 2024 it is written that liquidation value will be done of the valuation will be done of the assets on piecemeal basis. As a result of that, it does not have a big effect on real estate or immovable asset, but it has a very big effect on machinery. In case of a process plant, if a valuer takes the value of the different parts of the process plant on piecemeal basis, then the value comes down drastically. And that is why in most of the cases, the liquidation value of the machinery in India up to this 2025 has been given in a very small amount. If the fair value comes to about market value or fair value of the machinery at the time of for the purpose of secured lending, it was valued at rupees 100. Then when the liquidation value comes, generally we see not more than 20%. Sometimes it is 10%. Because in the previous definition, it was said piecemeal basis. But there was a long discussions in the standard boards, and then this definition has been finalized, which will be utilized after 31st January 2025. And we believe that that will increase the value of the liquidation value of the machines to a substantial amount. What is the definition now? The gross amount that would be realized when an asset or group of assets are sold from a liquidation sale. So there is no question of piecemeal basis sale, with the seller being compelled to sell as of a specific date. Fair enough. Liquidation value can be determined under two different premises of value. It remains the same: an orderly transactions with a typical marketing period, or a forced transaction with a shortened marketing period. So second part remains the same, but the first part, the main hindrance of selling the machineries in a piecemeal basis has been removed in the definition. So we expect now the valuation, now the liquidation value of the machinery will increase to a great extent. Market value, there is no change in the market value. What we have been using for the last more than a decade, the value definition remains the same. Use of must, you know very well, in IVS, whenever must is used, that means it is mandatory. That is mandatory. If you do not use it in your report, in your calculation, in your estimation, then your report will not be in compliance with the international valuation standard. What is an observable data? We have seen what is an data, and now we are seeing what is an observable data. Information that is readily available to the market participants about actual events or transactions that are used in determining the value for the asset or liability. So what is an observable data? A data which has its sources are defined, which you can observe. That is an observable data. In fact, for a valuation, all data are to be observable, supposed to be, because if you provide a data without disclosing the source, then it will not be a transparent valuation. The end users will unable to identify whether the data is correct or not unless the source is disclosed. So therefore, it is expected that to make a acceptable valuation report, I am not using compliant valuation report, I am using the term acceptable valuation report. All data's valuer should try to collect observable data. What is price? There is no such great change. The monetary or other consideration asked, offer or paid for an asset, price and value may be different. Professional judgment. So we are using everywhere professional judgment, and in many court in India, the judgments are uttered, the valuers are released by telling that it is a professional judgment. Now the definition has come up in the IVS. What it says? The use of accumulated knowledge and experience as well as critical reasoning to make an informed decision. My dear friends, so therefore it is not only accumulated knowledge and experience, it is also critical reasoning to make an informed decision. That means now on, if you give a valuation report and try to hide under the coverage of professional judgment and there is a mistake, you cannot escape, because it says that it should be a critical reasoning also. If you say anything, it should be reasonable, and critical reasoning comes from your evidence based. So definitely professional judgment would be from accumulated knowledge and experience, but also now on it has to be supported by critical reasoning to make it an informed decision. So there is no escape that it is only a professional judgment. You cannot accuse me for these mistakes in valuation. Professional skepticism, Kim has elaborately discussed. I am not going into that. Service organizations, because it is used that now on valuer can use a specialist as well as a service organization. So IVS has defined what is a service organization. It is an entity or segment of an entity that provides information, reports, or opinions, including but not limited to providing market data, credit ratings, or other services to support the valuation. If we give a specialist or service organizations, if we give a very small example in case of tangible asset, Kim has also given an example. I am giving a small example because in India, mainly the valuers are either engineer or architect. But when a plant and machinery valuer is going to value an yes, when a valuer of plant and machinery, suppose he has an experience of 40 years of experience working in steel factory, steel industry, huge experience, knows everything about steel industry. So, but he has been assigned with the job of valuation of a petrochemical industry. If he enters into a petrochemical industry or a chemical industry, what he will find? Only pipes and pipes and pipes, different shape, different sizes of steel pipes and valves and pumps, right? So therefore, he needs to have the expertise of a chemical engineer. And chemical engineer would be that specialist. And if the company is there who can provide the service of a chemical engineer, that service organizations that company could be act as a service organization, providing the valuer all the market data and everything about that chemical factory. And they can accompany the valuer as a specialist and give the requisite data. And it is ultimately the valuer who will do the valuation, but the chemical engineer will provide all the requisite data after inspection of that chemical factory along with the valuer. And the use of should. So we generally, that in IVS we use 3 words: must, should, and may. When it is must, that means it is mandatory. There is no change, no deviation from this. But if it is should, the use of accumulated knowledge and no. Definition is wrong here. I'm so sorry. It's not that. Should means that it is in between may and must. It is expected that the valuer will use it, but it is not mandatory. In those cases, the valuer has to use the word should, and rather the IVS use the word should. Then significant, any aspect of valuation which in the professional judgment of the valuer greatly impact the resultant valuation is generally we called it a significant input. And again, specialist is also defined like your organization, an individual or group of individual possessing technical skills, experience and knowledge required to perform or assist in the valuation or the review or challenge process. A specialist can be internally employed or externally engaged. Synergistic value, there is no change in the synergistic value definition because in 2015, the term synergistic value was used in place of marriage value. And it is, so I am not going to discuss in detail about the synergistic value. Tangible asset, first time the term tangible asset has been defined, a physical measurable asset such as, but not limited to property, plant and equipment. What is valuation? as such, there is no great change in valuation definition. The act or process of forming a conclusion on a value as of a valuation date that is prepared in compliance with IVS. Here it is important in the definition of valuation, these IVS introduced the relationship of valuation with IVS. So when a valuation is prepared in compliance with IVS, that is defined as a valuation as per the IVS. Valuation approach, it's a generic term. It says it's a generic term for the use of the cost, income or market approach. Valuation date, the point in time to which the valuation applies. Now the valuation date, when it is a retrospective valuation, means in case of very common example in India is the valuation for the purpose of capital gain. If any property is purchased before 2001, then as per the Income Tax Act, the assessee at the time of selling of the property for assessment of the capital gain can engage a registered valuer to estimate the market value, to estimate the fair market value of the property as on 1st April 2001, which is it is on a retrospective date. And the point is that it is the point in time to which the valuation applied in case it is 1st April 2001. But generally in other cases, what we do for transaction support or for your secured lending, generally we do the date in a present case basis. Valuation method, within valuation approach, a specific technique to conclude a value. Valuation model, valuation model, you need to give this definition in your valuation report when you use a quantitative implementation of a method in which or in part of that converts inputs into outputs used in a development of a value. Now one thing is there that valuation model, there is a difference between automated valuation model and valuation model. So valuer has to be little cautious using this term valuation model. They should not mix it up with the automated valuation model. There comes a very important definition in this, which is valuation process review. Now, in previous IVS, we use the word valuation review and valuation reviewer only, which created a lot of complexities while doing the valuation review process. Because sometimes the client wanted to know only that whether the process is correct or not. The process by which the valuation is done is correct, because the client used to challenge the other valuer's valuation report. They wanted to prove that the process is not correct. Secondly, sometimes the client wanted to prove that the valuation report is not in compliance with the international valuation standard. And sometimes the client wanted to prove that the value is not correct. So all these things, sometimes all the three components together, the client want to know. Sometimes only one component the client want to know. So if it is said that it's only a valuation review, that was giving a lot of controversy. That is why now it is clear. 10.35 it says valuation process review. So what is a valuation process review? An analysis by the valuer to assess compliance with IVS or a component of IVS applicable as at a valuation date. This does not include an opinion of the value. So it clearly states that when we say valuation process review, it does not include an opinion on the value. It is only you have to review whether it is in compliance with IVS or not. Then only valuation review. When client will say that we need a valuation review, then a valuation review is either a valuation process review or a valuation review or a value review or both. So it is mandatory for the valuer to ask to the client, do you want a valuation process review? Do you want a value review, or you want both? So that you can measure your working hours, and you can ask your fees accordingly, and you can prepare your valuation review report accordingly. Valuation risk. Valuation risk is a new terminology which is introduced here, and it will be discussed elaborately because so many questions I believe that you will ask. So please write down your questions to ask, not here today, but in other sessions. It only a single line definition, the possibility that the value is not appropriate for its intended use. That is defined as a valuation risk. You please do not ask me any question here. It will be elaborately, it will be discussed in later training classes. Then what is a value? Value is a valuer's quantitative conclusion on the result of a valuation process that is fully compliant with the requirement of IVS as a valuation date. So you see here also the value has been attached with IVS. If a value found is not by a process, is value found is not done by a process compliant with the requirements of IVS, it will not be treated as a value. So when it is valuation, whether it is value, then it has to be in compliance with the valuation IVS. And who is a valuer? There is no such big change in the definition of valuer. It's an individual, group of individuals, or individual within an entity, regardless of whether employed.
Sandeep sir, are you available? He'll just connect in 2 minutes.
So can you hear me?
Yes, sir. Yes, sir.
Screen is visible?
No, no, sir.
Is it visible now? Is it visible now?
Yes, yes, sir.
Yes, 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 visible.
Okay. So I'm so sorry. So you see, there is no change as such in the definition of valuer. So you remains as a valuer. IVS does not touch you. Value review, before that we have told about screen not visible.
It is
Yeah,
visible,
screen
sir.
visible. Screen
Okay,
visible.
okay. because I saw one said that screen not visible. So valuation review, we have seen the definition of valuation process review is given, valuation review is given, and now comes the third one, that is value review. Now what is a value review now according to the IVS? An analysis by the valuer applying IVS to assess and provide an opinion on the value on another valuer's work. See the difference. This does not include an opinion on the valuation process. So again, now IVS has made three parts of valuation review. The client could ask you give me a value review only. That means whether the other valuers work on valuation, the figure is correct or not. Second one, whether the valuation report has been prepared in compliance with IVS or not. Third, I want both of them. I want whether the value is correct or not, as well as it is in compliance, it is prepared in compliance with IVS or not. So now it is absolutely clear by IVS how the review will be done. Now, in the previous IVS, we have seen two things, weight and weightage. Weight. Now here the weightage portion has been deleted, only weight is there. The amount of reliance placed on a particular indication of value in reaching a conclusion on value. Because IVS wants that valuer should try to investigate all the three approaches, try to find out the value by application of all the three approaches. Even in one approach, he should try to get different, he is getting different data from different kinds of sources. Then which sources he is giving more weightage? That is very important. And IVS also stated that averaging is not permitted. So depending on the confidence of the valuer, depend on different aspects. Say you have found out one evidence which is in the same building. You have found another evidence which might be 100 meters away from the property. And it might happen that you have got a evidence which is about 5 kilometers away from the property. Three evidences are there, same kind. Then as a valuer, you cannot take an average, it is not permitted, same time. But depending on their location, you can provide proper weight on three different evidences. The value that you are trying to find out, which is a lower weight, which is a medium weight, and which is the best weight, highest weight. So that is why weight is very important to understand and to provide in your report when it is an evidence-based report in compliance with international valuation standard. So that's all about the glossary. So you see that in glossary you have 41 number of definitions that you are to use, and generally what we do in our present day valuation report, we used to provide a different section as definition or glossary. The terms that will be used in our valuation report, which has significant, I should say significant weightage in your report, it is better to define those in that section of your valuation report. So that because your client may not be conversant with the technical terms that you are using. And IVS said that your report should be such that it should have transparency in every aspect. So if you provide the definitions in a small, chapter in your report, that will help your client to understand your report. And more your client will understand the report, more and more it will be acceptable to he or she, right? So this is all about glossary. And regarding your IVS 100, everything has been covered by Kim, my chairman in the Tangible Asset Board. And one thing I must say, what Kim also wanted, that why not people asking about the quality, the control, because there were so many discussions regarding control. Then Definitely not valuation principles. There is no such change, but valuation process quality control is a big area in which I believe that Indian valuers are going to face a big, challenge. What is that challenge? Challenge is that I will ask, on behalf of the Indian valuers, my question to him, that we have asked for, so many things under this valuation process quality control. We said that there must be valuation process quality controls around the valuation process. Fair enough. The controls helps to ensure valuation. Fair enough. The extent of control should be determined having regard to the intended use. Fair enough. The control should assess the judgments made during the valuation, including their reasonableness and freedom from bias in determining the value. All these things are really, if we can make such type of control over the valuation process, the valuation will be highly acceptable to all parts. But the question is that, which was raised also, that can an individual who is running his business as an individual, having a very one or two employee only, is it practical and is it possible for him or her to make such control? Because you see, the control said, sorry, let me go to that one control. Huh. 20.6 is a big challenge. What it said, because it may happen that individual valuer can act as a controlling officer also, because once he complete the valuation report, next day he will go through the entire valuation report and try to find out, checks and balance, try to find out by himself if there be any problem or not. But see the 20.06, what it said? It said there should be periodic assessment of the controls to ensure that their integrity and completeness are appropriate as of the valuation date. The periodic assessment should be documented. If the valuer is able to 20.07, let's go to 20.5. Again, it said what 20.5 said? It said that the control should be documented. The documentation should contain sufficient detail to allow another valuer applying professional judgment to understand the effectiveness of the control. So, on behalf of the Indian valuers, it is my request to the chairman of the Tangible Asset Board to kindly explain how it would be possible for an individual valuer running a small firm to make these controls documented so that it could be understood by the other valuers and periodic assessment of the control will be done. This is a big challenge. So on behalf of everybody, this is my question to you, sir. King,
Thank
please.
you, Sandeep. You're just keeping me honest and paying me back for the cricket at the moment. In response to 20.06, I would suggest that that wording means that a valuer or a valuation firm needs to consider the policies that they might have in place on a periodic basis. And so, for example, if you are an individual valuer, or if you are a firm, or if you're a global multinational and you have valuation policies that you adhere to in performing your valuations, then I think 20.06 means that you need to periodically assess if those controls are still appropriate, say on an intermittent basis. So you might sit down and you might review those annually to make sure that they are still fit for purpose. So 20.06, if you're an individual or a firm, I still think that that is okay. There, 20.07 is the challenging one. So if you're a valuer, are you able to adequately assess valuation risk? Are you able to consider your own valuations, adequately review them? And so, there are various different ways if you are an individual valuer where you might go about this. So you might consider doing a peer review of someone else's work. So you might have a colleague within industry that you have an agreement with, that you might consider doing peer reviews of each other's work. That might be a mutual agreement that you might have in place. It is a challenge where you are an individual valuer, but in coming to the conclusion and the formation of this particular section, the Standards Review Board did have particular consideration that it was very important because of the nature and the nature of the industry and structure of the industry, that individual valuers or one-person firms were able to comply with the standards. And so by wording 20.07, we think that it could still be possible for individuals as well as firms to be able to adhere to that Section 20 of IVS 100. But, individuals will need to think about how they adequately cover valuation risk of their own valuations. Do they need to consider doing peer reviews with other third parties? That might be a way to allow them to perform that. And 20.08.
20.05. You come to please 20.05.
It should be documented. Okay, so the documentation should contain sufficient detail to allow another. Yeah, okay. So I think when we're thinking about that particular section, we think about the fact that you might have internal valuation policies that you might consider. That would be one thing. So that would be policies that you would follow for all valuations. But then to the extent that you have a particular item of valuation risk or quality control that comes up in a particular valuation assignment, then the valuer should document how they have dealt with the quality control pertaining to that particular issue or that particular aspect of that particular valuation, and have a note on file to make sure that any of the processes or controls that they have followed as part of that valuation are documented as part of that valuation. So I think 20.05, 20.06, I think they are fine to be able to cover those as a firm or as an individual. 20.07, I think, requires individuals in particular to take a little bit more detailed note and considered thinking around how they're going to comply with that section.
Thank you very much. Thank you very much. I believe that my valuers, they have understood that nowadays, in future, they have to make another challenge. They have to face another challenge regarding control. So I would request our AARVF to make a model control policy for the valuers so that it can be distributed among them and they can make their, if there be any changes required for their individual firms, they can make the change and can utilize that policy as a control policy of their valuation to make all their valuation report compliant to the international valuation standard. So with this, I believe nobody has any question further, and we have come almost at the fag end of our program, and this is just the beginning of an 8 weeks tour, and afterwards in every Friday we are coming with every standard. We have started with IVS 100. Next week we will discuss IVS 101. So I would like to request Rahul or Saurav to please come and please propose the vote of thanks to end the program.
Thank you, sir. Thank you so much. Thank you, Kim, and thank you, Nick, for this wonderful session. And yes, we have taken this suggestion from Sandeep, sir. And of course, we will put up with the committee and we'll float it for our valuers. And I would request Saurabh as well to give a vote of thanks, our MD of AARBN.
So thank
As
you
we
so
know,
much. Thanks
yeah,
to all the
please.
participants. Thanks, Rahul. And thank you, everyone. Thank you, Nick, for taking time out, for coming out and addressing everybody and then letting you know what is new and what is the expectation of IVSC towards India. And I would also like to extend my thanks to Kim, Sandeep sir, and all the participants. And thank you for all the credit goes to Sandeep sir for actually formulating and then coming up with this thought that we should train our members as to what is new in this IVSC 2025. So it was a very insightful session. And Sandeep sir, you mentioned about the control policy. Yes, we will definitely work together on it, and let's formulate this policy, sir, as you have recommended. So thank you everyone for joining. Rahul, last minute thoughts.
Our next session will be on 10th of January, scope of work, and the next speaker will be Alexander. I think he's also available here. Alexander, if you can just give a summary. He's here. Okay, I think he might be out of his seat. Yes. Yes, Alex.
I'm looking forward to, I will be presenting you IVS 101 scope of work next week. You may also know it as terms of engagement. Obviously, it's an extremely important part of the valuation process, and the scope of work should connect to the documentation and reporting. So what you say in your scope of work is what you do. In your documentation and reporting, it's what you've done. And I very much look forward to presenting to you all next week. I just wanted to clear up on should as well. Should in the glossary, it's presumptively mandatory. So that means that you should follow it. We no longer have a may, but there may be reasons why you don't need to follow it. For example, you may have to follow particular statutory regulation in relation to evaluation. You may have to follow VPO requirements or national requirements within your country. And in those instances, you should state your reason for not following IVS. They will act as a protection to you. So I hope that helps as well. I look forward to presenting next week. Sorry, I'm dressed a bit casually. I'm in the process of resetting up my computer at the moment. So I have drilling going on in the other room, which is why I've been on mute with no video. But I wish you all a happy new year, and I'm really looking forward to presenting next week. Thank you.
Thank you, Alex, for your words. And thank you all the valuers for joining in this session. And thank you. We had a great support today. And of course, we see you next week on Friday at the same time. Thank you once again.
Thank you, sir. Thank you so much.
Thank you.
So
Thanks,
till then,
everyone.
Thank you, sir.
goodbye. Enjoy the
Happy New
weekend.
Year.
Bye bye.
Thank you, sir. Happy
Bye-bye.
New Year.
Thank you, sir. Thank you.
Thank you, sir.